So the jobs number today was a big miss. The non-farm payroll report always comes out the day after the ADP report, and the ADP report, in case you're unfamiliar, is sort of based on a survey of a bunch of companies in different industries, and it's a private firm that puts the number together, and that's sort of their estimate of how many jobs were added on payrolls across the country in the previous month. And then the Bureau of Labor Statistics puts out their estimate the next day. And people were quite optimistic after the ADP number yesterday. In fact, President Trump tweeted out a very simple phrase. He just said, "Great jobs number," which it was. It was pretty high. It beat expectations. I believe it was something like 195. I don't remember now because, of course, now the BLS number is out, the Bureau of Labor Statistics, and the estimates for the BLS number was a bit lower than what the ADP number was yesterday, but people were hoping maybe since the ADP beat estimates that the BLS number did too. And at the estimate set at 150,000, not only did BLS not beat that number, they actually missed it by quite a bit. The actual number, at least this is the first estimate, because the BLS comes out with their estimate and then they revise it later, typically down. That's the direction we've been going. They've been revising all the employment numbers down, in successive months. It's only 130,000 this month, so that's a big miss. Especially since last month also got revised down from 164,000 to only about 159,000, I think. And then the month before that, which was, was it June or May? Yeah, June. June was also revised down. So the 3-month average now is 156,000. Which is not great, especially when you consider that this month's number is helped out quite a bit by the Census Bureau. Of course, the census is something that is taken only once every 10 years in the United States, and those jobs are always temporary, but it does help out the employment numbers for a short time when the census is taken. The same thing happened back with the 2010 census, which happened right after the great crash in 2008. The hiring of all the census workers back in 2009 helped the employment numbers look better than they actually were, because, of course, as soon as the census is done, all those census workers get fired because it's a temporary job. And so of the 130,000 jobs that were created this month, about 25,000 of them were census workers. So obviously without the census, this would have been a terrible jobs report. It would have been only about 105,000. And then when you factor in the rest of the government jobs that were added, the actual private sector, the real economy that produces things, jobs, those only increased by 96,000 this month. So that's a pretty terrible number. And now by this point you might be wondering, now why am I talking about this if it's just 1 month? I mean, 1 month doesn't really, it's like the difference between weather and climate. Having one bad jobs report doesn't mean that the jobs market is in bad shape. Just in the same way that having one hurricane doesn't mean that that the climate is getting more extreme. Well, the reason is I wasn't going to talk about this today because it is just 1 month, could be a bad month, until I saw the year-to-date average. Now, there's some conflict over what the year-to-date average is, but both, no matter which method you use, whether you take the initial estimates or you try and factor in what the revisions may be in the future, no matter how you do it, in 2019 so far, the average is down significantly from 2018, meaning that jobs are being added at a slower pace this year than they were last year. And so here we are, a decade into this business cycle, and jobs growth is slowing significantly year over year. That normally does not spell good news for the economy moving forward. If you just use the straight Bureau of Labor Statistics data, I believe that the average for 2018, based on all their estimates, was like 223,000 jobs added a month, and this year so far, it's only at about 158,000. Now, there was someone I saw on Twitter who tried to factor in, sort of the error rate for how much the BLS overestimates the jobs data, which they do often, and then end up having to go and revise it back down. They came up with different numbers, factoring that in at 183,000 for 2018 and only 129,000 on average per month in 2019. So no matter which method you use, jobs growth is slowing. Doesn't look good. And for those of us who have been expecting a recession for some time now, this would make sense because employment is always the last shoe to drop. A recession always begins officially when employment has peaked or when unemployment has bottomed. And so not only has unemployment been pretty low now and not going any lower, because you can't get much lower than 3.7%. The other non-employment metrics for looking at the state of the economy, the recessionary indicators, those have all been signaling red, which again would make sense for those to start giving us bad signals before unemployment starts to change, before the job market starts to slow or even get worse and reverse, and we start to see unemployment ticking up. But before I get to that, something interesting I noticed is that even though the U3 number, which is the headline unemployment rate, stayed the same at 3.7%, those of you who study, economics much know that the government has a very convenient way of measuring unemployment, and that the U3 number is not necessarily the most accurate number for gauging how healthy the job market is. There are a few different numbers. One of them is the U6, and the U6 is not necessarily the best either, but at least it'll include a few extra people, like folks who have been unemployed for a long time. Because, of course, at a certain point, if you're in the headline unemployment rate, people who are unemployed for, I think it's like 99 weeks, they drop out because they're not considered a part of the labor force anymore. If you stay unemployed for too long, they just consider you to be someone who's not working out of choice or something like that. And I believe the U6 number also includes people who are underemployed. So that number, interestingly enough, didn't go up much, but it went up 0.2%. So it is something. So that is a little bit of a change. I don't think that that's necessarily a signal at this point. It could just be noise. But CNBC noted that there was about 397,000 people this month who took on a part-time job because they're trying to make ends meet. So if people are picking up part-time jobs, which you never pick up a part-time job really as a career, you do that because you need extra money, that to me doesn't bode well for the health of the consumer in America. And speaking of consumers, I think that the consumer is in pretty bad shape overall. We've been seeing that credit card debt and, of course, student loan debt has been going up quite a bit. And, of course, every person has a limit, really, on how much credit they can take out. They all have, they can only lever themselves up so much. So if you're, funding consumption with credit card debt and not paying it back, then, you're going to get to a point to where you're just tapped out, which I think we're starting to see with a lot of consumers. Consumer confidence has been, in the last University of Michigan poll, was down quite a bit, if I recall. Which is natural when you've had a 10-year business cycle. People, that's kind of why we have business cycles, is because, we accumulate so much debt that cannot be paid back, and then people end up in mass just having to go bankrupt and letting that debt sort of roll off their balance sheets. And so it's this oversaturation of debt that I think is the reason why we're seeing, for example, mortgage applications are down, even though interest rates are falling. You would think that if interest rates are falling, mortgages are becoming more affordable, and that people would be able to, buy homes or refinance their house or things like that, and they simply just can't. They can't take out any more debt. Now, of course, we've also got the fact that the Fed has stopped hiking, and of course, when the Fed is in a hiking cycle, the first thing that they do before they start going into an easing cycle, trying to give the economy a soft landing before a recession, or sometimes at the time of the recession, the first thing they have to do is stop hiking. So since the Fed has stopped hiking and they actually have started cutting, and will probably cut again very soon, that's another sign that, we're on the cusp of the downturn. And finally, there's that pesky inverted yield curve, which again also predates recessions and predates the uptick in unemployment. So I think that from the data, it's pretty clear that jobs growth is slowing in 2019, and we may very well see an uptick in unemployment heading into next year. So if you gained anything of value out of this video, I'd appreciate you clicking that like button and subscribing. And if you do subscribe, please do click the bell, because I do upload every day and I'd hate to have you miss one. So I'll see you folks back here tomorrow.